Have you ever seen a news headline screaming about the next big thing? That one stock, that one crypto, that one investment that's going to the moon? Your friends are talking about it, social media is buzzing, and you feel this intense pressure, this FOMO, the fear of missing out. You think, this is it, this is my chance to get rich quick. But what if I told you that the truly wealthy, the people who have built and sustained their fortunes, actively run in the opposite direction from these hot investments? It sounds counterintuitive, right? But today, we're going to pull back the curtain and reveal why millionaires prioritize something far less glamorous, but infinitely more powerful than chasing trends: rock-solid risk management. This isn't just about protecting what you have. It's the secret sauce to building lasting wealth. So let's break down the psychology of a hot investment. It usually starts with a compelling story. Maybe it's a revolutionary new technology, a disruptive business model, or just a massive surge in price that catches everyone's attention. The media amplifies it, creating a feedback loop of hype. Everyone starts to believe it's a sure thing. The problem is, by the time you, the average retail investor, hear about it, the smart money, the early investors, have often already made their profits. They got in when it was unknown and undervalued. Now, as the price skyrockets based on pure speculation and media frenzy, they are quietly selling their positions to the wave of newcomers rushing in, driven by FOMO. You're not getting in on the ground floor. You're potentially buying at the peak, becoming what they call exit liquidity. Think of it like a crowded concert. The die-hard fans got their tickets months ago. Now, just before the main act, scalpers are selling tickets outside for 10 times the original price. The people buying at that point are paying for the hype, not the intrinsic value. Millionaires understand this dynamic perfectly. They aren't swayed by popular opinion or market noise. Instead, they operate on a completely different set of principles. Their primary question isn't how much can I make? It's how much can I afford to lose? This single shift in perspective changes everything. They see their capital not as a tool for gambling, but as a base to be preserved and grown steadily over time. Losing a significant portion of your capital is devastating. It doesn't just set you back, it can take you out of the game entirely. If you lose 50% of your investment, you need to make a 100% return just to get back to where you started. That's a steep, stressful hill to climb. This is where the concept of asymmetric risk comes into play. It's a cornerstone of sophisticated investing. Simply put, wealthy investors look for opportunities where the potential upside is significantly greater than the potential downside. They're not looking for a 50-50 coin flip, even if the potential reward is huge. They're looking for baits where, if they're wrong, they lose a little, but if they're right, they win a lot. This might mean investing in early-stage companies, but they do it with a very small, calculated portion of their portfolio, an amount they are fully prepared to lose. For the vast majority of their wealth, they stick to proven, boring, and predictable assets. Things like diversified index funds, blue-chip stocks with long histories of paying dividends, real estate in stable markets, and high-quality bonds. These aren't the investments that will make you a millionaire overnight, but they are the investments that will keep you a millionaire for a lifetime. Let's look at a real-world example. The dot-com bubble of the late 90s, everyone was quitting their jobs to day trade internet stocks. Companies with no profits, sometimes no revenue, were reaching billion-dollar valuations based on a dot-com in their name. It was the hottest ticket in town. People who piled their life savings into pets. Com at its peak were financially ruined when the bubble burst. Meanwhile, disciplined investors like Warren Buffett were publicly criticized for not getting it. He was called a dinosaur. But he stuck to his principles of investing in businesses he understood with predictable earnings. He avoided the frenzy. And when the crash came, his portfolio was safe, and he had a mountain of cash ready to buy up incredible, high-quality companies at bargain bin prices. He didn't chase the heat, he waited for the value. That's the difference between gambling and investing. This mindset extends beyond just the stock market. Think about real estate. A hot investment might be buying a condo in a speculative, overhyped market where prices have doubled in a year. The risk is immense. A millionaire investor, on the other hand, is more likely to buy a multifamily apartment building in a neighborhood with stable job growth and rising rents. The cash flow is predictable, the asset is tangible, and the long-term demographic trends are in their favor. It's less exciting, sure, you won't be bragging about your 100% gain in 6 months. But you will be collecting rent checks month after month, year after year, while your asset slowly appreciates in value. One is a lottery ticket, the other is a business. So how can you apply this millionaire mindset to your own financial journey, no matter where you're starting from? First, kill the FOMO, unsubscribe from the hype. When you feel that urge to jump on a bandwagon, take a deep breath and step back. Ask critical questions. Do I truly understand this investment? What is the real underlying value here, separate from the hype? What is the absolute worst-case scenario, and can I financially and emotionally handle that outcome? Second, build your foundation first. Before you even think about speculative plays, make sure you have a solid core portfolio. This means a well-diversified, low-cost portfolio of index funds or ETFs that track the broad market. This is your bedrock. It's the boring, slow, and steady engine of wealth creation that works for you while you sleep. Third, define your play money. If you absolutely want to try your hand at higher-risk investments, allocate a very small percentage of your portfolio to it, say, 1 to 5%. This is money you can afford to lose entirely without it impacting your long-term financial goals. This strategy allows you to scratch that itch for excitement and potential high rewards without betting the farm. You get the potential upside while strictly capping your downside. This is how the wealthy manage risk. They don't avoid risk entirely. They measure it, manage it, and ensure it can never deliver a fatal blow. They know that the secret to winning the long game isn't about hitting home runs every time. It's about consistently getting on base and avoiding striking out. Ultimately, the market is a psychological battlefield. It preys on our most primal emotions, greed and fear. Hot investments are the perfect bait for greed. The subsequent crashes are the perfect trigger for fear, causing people to sell at the worst possible time. Millionaires build their wealth by detaching from this emotional roller coaster. They have a plan, a system, and the discipline to stick to it, regardless of the market's daily mood swings. They understand that slow and steady isn't just a viable path to wealth. For most people, it's the only path that truly works. So the next time you see that can't-miss opportunity, remember the real secret of the wealthy. Don't chase the heat, build a fire of your own, one that burns slowly, steadily, and for a very, very long time. Thank you so much for watching. If you found this perspective on investing helpful, make sure to hit that like button and subscribe for more content on building sustainable wealth. Let me know in the comments what is the hottest investment you've ever been tempted by. Stay disciplined, and I'll see you in the next video.